Hey everyone, how's it going? We're here today talking about unit economics. So to start, we'll talk about the concept of unit economics. The first concept here is just the sale price. How much money do you get from selling that unit? When you break that down, the first thing that comes out is the COGS, the cost of goods sold. So what does it cost to physically make the thing that you're selling? The next thing is sales and marketing. How much does it cost to actually sell that unit that you're selling? And then what's left over as a total component of that price is the contribution profit. So that contribution profit is the portion of the sale price that is the unit profitability. It's really important to recognize that the COGS includes all the ongoing costs, all the variable costs in economic terms. Venture investing is naturally, it's built on this idea of unit economics. The whole point is that we invest in businesses that are unprofitable overall. They're losing cash, they have negative net income because the units that they're selling are actually profitable. So at a large enough scale, the entire company will be profitable because those fixed costs like R&D that are invested in building the product will kind of, round down relative to the high number of units and the unit profitability that's coming through. If a company's not unit profitable, this is kind of like being negative gross margin, meaning the more you sell, the more you lose. You're really not running a good business if you're not unit profitable. You're selling $1 for 75 cents. And of course, you can get lots of customers if you sell $1 for 75 cents, but it's very, very difficult to build an interesting business. The other thing is that in a lot of businesses, as they scale up, the unit profitability actually goes down. And so if you're not unit profitable at a small scale, it's a hard argument to make that you'll be unit profitable at a large scale. Of course, there's big exceptions that we can all think of, that we all know that have the opposite thesis of that and that prove the opposite of that. But in general, CAC goes up and pricing pressure comes in, and so unit profitability is best at a small scale. One of the key questions that I want to talk about is the unit. What is your unit for the business? Because if you can't figure out what your unit is, then it's very difficult to figure out what the unit economics and the unit profitability is. In SaaS, which is a lot of what I focus on, the unit is usually the customer, and sometimes it's a cohort. Sometimes if you have really small customers, it's better to look at a group of customers together. Often looking at both is a good way of doing it, and I'll get into a little bit more on why later. So now that was a kind of static, steady state point. Now, if we move over to like subscription businesses, it becomes, like I always say, a calculus problem because we've introduced this concept of time. So if we look at a non-recurring setup, again, we've got the CAC and then we've got the contribution profit. Now, I'm using contribution profit here as basically the revenue that comes minus the the COGS, really the gross profit that comes as a result of selling it on an ongoing basis. So that's on a non-recurring basis. If we look at it on a recurring basis, we still have that one-time CAC, but now the contribution profit is spread out over a longer period of time. And the total contribution profit, which really is the lifetime value, is the sum of that. And so anytime we're summing something over time, within calculus, it's we're taking an integral of that curve and summing it up. Again, important just to review here, the CAC costs are what's incurred up front. That's the fixed costs. And then the ongoing expenses come out of that contribution profit. The infinite sum of contribution profits is lifetime value. Now, practically speaking, doing an infinite sum on a customer that has normal human behavior is not the most practical thing in the world, which is why anyone who's talked to me basically knows that the concept of LTV is great, but in practice, actually calculating it is almost impossible. And there's a bunch of other things you can do to get to the unit profitability of a SaaS business. This note here is just kind of an interesting point about misallocating expenses, which I'll get into at the end of this little talk. So to illustrate this a little bit more, that the time is really an important factor. And one of the best ways, to ask this unit profitability question for a SaaS company is, when do you become unit profitable, or how long do you need to keep your customers in order to be unit profitable? This is another way of asking the CAC payback question. And you can ask CAC payback on a historical basis or on a forward-looking basis. And that's why it's probably my favorite SaaS unit economics metric. So this is just an illustration. Again, let's say we have $200 for CAC in that first month, it's a $50 contribution profit, and then we get that same contribution profit month after month after month. Now, this is 2, 4, 6, 8, 10 months. And if it's $50, we can see that let me move my circle here, the contribution margin, it's negative 150, then 50, 50, 50, 50. And as that accumulates over time, right here at this point in month 4, we hit the break-even point. And what this really tells us is that we're unit economics negative up until that point, and then we become unit economics positive. One thing that you'll often hear is, what's the churn rate? What you usually don't hear is, what's the time to churn? And time to churn is a super important metric for a company, especially that's doing monthly contracts with their customers. If you're doing annual contracts, generally, as long as this number, which in this case is 4 months, is under 12 months, then you're safe, because usually you've already collected their cash up front. So even if you stop using the product, you still are unit economics positive, even if they'll churn after the end of the year. And it kind of relaxes it a little bit, I guess. It also means that, obviously you want to deliver a high quality experience to all your customers, but at the same time, if you don't, they can't really do anything after a year. Whereas if you have a monthly contracts, you need to keep delivering high quality service, high quality products, updates, everything, every single month, just to keep the customers that you have. Now we'll talk about, switching gears, marketplace unit economics. So for this, I'll talk about an example. So let's talk about a standard marketplace. You have a seller on one side, and on the other side, so you have 4 buyers. So now, how did we come up with that ratio of 4 buyers to 1 seller? We know that historically, based on our data, that 1 seller sells 4 items per month, and 1 buyer buys 1 item per month. So therefore, to get 1 unit of 4 items sold and bought or transacted, we need 1 seller and 4 buyers, and that becomes our unit. The reason that we can't just have a buyer or just have a seller is that marketplaces are all about balancing supply and demand. So the value of a buyer or a seller really depends on the balance in the market. You probably remember, I don't think they do this anymore, but Uber was offering like $2,000 in credits or bonus or cash for drivers. And the reason why was that they really needed drivers. And because they had a lot of demand. And so the value of a driver was super high in their marketplace at that point in time. The other point here is brand marketing. Oftentimes in a marketplace like eBay, buyers and sellers is probably a lot of overlap. So it's really hard to break them apart. It's also really hard to break apart the marketing budgets. So now if we go into some of the math here, let's say, so we figured out that the unit here is 1 seller and 4 buyers, and that's the ratio of the exchange of items. So though it's 1 seller, 4 buyers, and 4 items, and the time period is 1 month. So if we do the math on this, we can say 4 items, $100 per item, and a 10% take rate, that's $40 per month in contribution profit. The cost of acquisition, let's say for the seller, it's $100. For the buyer, it's $25 each. That's $200 in total CAC, and therefore the CAC payback is 5 months. And that would be really good, just if you kind of benchmark it against other things out there. Let's quickly switch to another screen and talk about the impact of misallocating an expense as one-time relative to ongoing. And so if we switch to here, I built this model in Causal that just quickly shows the impact of making this actually fairly common mistake. And one of the reasons that this is a common mistake is that, again, we're talking about economics here. We're talking about how businesses run. From an accounting perspective, it might be a different story. And so one area that this comes up often is service, customer success, customer support. These people often sit under the sales and marketing line item umbrella inside a company. And so when we look at CAC, those might get included in CAC. Whereas in reality, you really need to scale that team up because all of your customers need ongoing support. And so it's an ongoing variable cost that moves with your customers. So this is a very simple model that runs a couple different scenarios at the same time. So you can just see the illustration here. This has $45 MRR, an AWS cost of $4 per month, processing fee of $2, right? Sales cost of $70, marketing cost of $30. So these are going to be one-time expenses. The AWS cost is only $4, but the service cost is $15 per month. So if we flip this to being a one-time cost, right, like it is now, it's a one-time cost, then the cumulative value is $275 for that customer. Now, if you don't really need to flip it because I'm showing both scenarios at the same time, but this lines them up, and then this will show them separately. But if it's an ongoing expense, then the total value is only $140. So it's pretty dramatic, and you can see that this is like it could be a fairly common mistake, right? If this is only $10, we can see that yes, it's less dramatic, but it's still fairly meaningful. So I hope that was interesting. Feel free to reach out with any questions.